separately or as a combined investment opportunity set?
Yes, as you know, in China you have the A share market, which is reserved for locals, B shares, which foreigners can buy, and then you have in Hong Kong, the red chips and the H shares, which are Chinese companies that you can invest in Hong Kong. One of the things that's happening is that the Chinese are gradually opening up the A share market. So we can get special permission to invest in a select list of A shares, which is gradually happening. But the A share market is dominated by the local investor. So the behavior of that market is quite different than the behavior of, let's say, the Hong Kong market, the H share. Of course, there is some correlation between the two, but there's a different mentality. Because of the foreigners buying the Hong Kong Chinese companies, listed Chinese companies, are looking at valuation, they're looking at growth, they're looking at these other factors, whereas the local investor is looking at the government. They're listening to what the government policy is. If the government says, we think the market should go up, the market goes up. So recently, as you know, the Chinese government has been cracking down on these trusts. They have these funds in China. By the way, it's really interesting. If you go to China, it's a freewheeling situation in the financial area because they're experimenting. And what happened is that the banks reached their limits of lending. So in order to earn money, they started funds where they put loans into these funds or other assets into the funds and sold them to high net worth individuals. And they told these people, look, you can get more, potentially better returns than putting your money in a safe deposit box or in the savings deposit, but there's a risk. Of course, most people don't listen because they figure, look, I'm buying this from a bank, they will guarantee my returns. And now the government is waking up to the reality that they could have real problems, demonstrations and so forth and so on. So what they do is they say, okay, bankers, start buying back your funds. Now what does that do to the stock market? It creates a negative feeling in the stock market. So you see the Asian market go down. So a lot of this is based on government policy, and that's the real difference. So you have to watch this very, very carefully. In the long run, of course, it's going to be great as we can invest more and more in these Chinese companies, because most interesting is not necessarily the state-owned, the large giants, you know, the four major banks, Chalco, the big aluminum company, the oil companies. Sure, we can invest in those, but what we're interested in is small and medium enterprises that are really going to do very well, and the internet companies. But of course, we can get exposure to the internet companies through the New York Stock Exchange. Alibaba is listed on the New York Stock Exchange. So it's a very mixed picture, and you've got to watch it carefully because things are going to really change. And the objective of the Chinese government, of course, will be to attract more foreign investment into China so they can allow more money to come out of China. You know, right now, you know, they're under pressure because the renminbi is getting weaker and Trump doesn't like that. So they have to stabilize that situation and allow the renminbi to get stronger, or at least not get any more weaker by attracting more foreign investment. And that means allowing a more liberal foreign investment policy.
This is all very, very interesting.